Stop. The government just gave you a raise, a 2.8% cost of living adjustment to your Social Security. That's about $56 more per month. Sounds good, right? But here's what they're not telling you. Medicare Part B premiums just jumped nearly 10%, from $185 to $229 per month. That's $17.90 gone immediately. Your real raise? About $36 a month. Barely enough for a tank of gas. And for millions of seniors, the math is even worse. Some are seeing their entire COLA wiped out by healthcare costs. Zero real increase. And here's the number nobody is explaining. Some beneficiaries are seeing benefit figures above $2,400 a month. But what actually lands in their bank account is completely different. Medicare deductions, tax withholding, IRMA surcharges. By the time all that hits, your check is hundreds less than you expected. In the next few minutes, I'm going to show you exactly what's happening to your Social Security in March 2026, why your check might be smaller than you think, and the 3 things you must do right now to protect your retirement income. If you're living on Social Security, you need to hear every word of this. I'm Zane, and this is Senior Security Updates. Here's what nobody is telling you, and it's costing you money every single month. The government gave you a raise this year, a 2.8% cost of living adjustment. That's roughly $56 more a month in your Social Security check starting in 2026. Sounds decent, right? But before you get excited, let me show you what they did with the other hand. Medicare Part B premiums just jumped nearly 10% from $185 a month all the way up to $229. That's $17.90 a month gone before you even see a dime of your raise. And for millions of Americans with lower benefits, the math is brutal. Your effective COLA is essentially zero. Gone. Eaten alive by healthcare costs. And here's the number that's catching everyone off guard. Some beneficiaries are seeing Medicare-related adjustments pushing their gross benefit figures above $2,434 a month. But what actually lands in their bank account tells a completely different story. The maximum Social Security benefit in 2026 can reach up to $4,873 for those who worked the system right and delayed claiming. But most folks, they never planned for this. They trusted the government to take care of them, and now they're sitting at the kitchen table wondering why their check doesn't stretch like it used to. I've been doing this for 30 years, and I'm telling you, the numbers are not what Washington wants you to focus on. You need to understand the full picture of what's happening to your money in March and beyond, because nobody is going to protect your retirement except you. Let me walk you through exactly what is happening step by step so you can stop guessing and start knowing. I want you to picture something for a second. You worked for 40 years. Maybe you were a teacher. Maybe you drove a truck. Maybe you ran a small business out of your garage. You paid into Social Security every single paycheck. You never missed, you never complained, you trusted the system. And now you're retired, living on a fixed income. And every single January, you sit by the mailbox or you check your bank app waiting to see if that cost of living adjustment actually made a real difference in your life. And every single year, the answer is the same. Not really. I need to talk to you today about March 2026 because something significant has shifted. And if you don't understand what changed and why, you are going to make decisions about your money that could hurt you for the rest of your retirement. That is not dramatic. That is just the truth. So, let's start with the COLA, because that is the number that gets all the headlines. For 2026, Social Security recipients received a 2.8% cost of living adjustment. Now, the Social Security Administration calculates that number based on the Consumer Price Index for urban wage earners and clerical workers, the CPIW. And they compare the third quarter of the previous year to determine how much prices went up, and then they adjust your benefit accordingly. Sounds fair, sounds reasonable, and on paper, it almost is. But here is where I want you to slow down and really listen to me, because the headline number is almost never the real number that matters to your life. The average Social Security benefit for a retired worker in 2026 is somewhere in the neighborhood of $1,976 a month after a 2.8% COLA. That's about $54 more per month than what you were getting in 2025. Now, $54 sounds like something. It's not nothing. But before that money ever reaches your account, Medicare Part B premiums are automatically deducted, and here is exactly where the story changes. Medicare Part B premiums for 2026 jumped to $229 per month, and that is up from $185 in 2025. That is a $17.90 per month increase, so you gained roughly $54 from COLA and you immediately lost $17.90 to Medicare. Your real effective raise is sitting somewhere around $36 a month. That is barely a tank of gas. That is not keeping up with what you are actually paying at the grocery store, at the pharmacy, at the doctor's office. I am not making this up to scare you. These are the actual numbers, and I want you to be able to look them in the face without flinching. Now, let me talk about the $2,434 figure because that is a number that has been circulating and confusing a lot of people. And I want to cut through the noise right now. The number that many people are referencing when they talk about $2,434 relates to Social Security disability insurance payments and specific beneficiary categories where Medicare premium adjustments and benefit calculations combined to produce that figure. For some recipients, particularly those who have high enough benefits that Medicare premium deductions put their gross benefit in that range, that number is very real. But what catches everyone off guard is not that the number exists. It is that the amount hitting your bank account after all the deductions, all the Medicare costs, all the tax withholding if applicable, is significantly lower. And nobody explains that to you. The government sends you a letter in November called the Social Security Benefit Verification Letter. And most people look at the gross number, feel good about it, and then wonder why their checking account tells a completely different story in March. That disconnect is exactly what I want to fix for you today. Let me tell you about something called IRMA. Because if you have any kind of additional income in retirement, a pension, some investment income, a part-time job, required minimum distributions from your IRA or 401k, this could be hitting you. IRMA stands for Income-Related Monthly Adjustment Amount, and it is essentially a Medicare surcharge that the government applies to higher income retirees. If your modified adjusted gross income from 2 years ago was above $106,000 for a single filer or $212,000 for a couple filing jointly, you are paying more for Medicare Part B and Part D than the standard premium. The surcharge can add hundreds of dollars per month on top of the standard $229. And here is what gets people every single time. They had a one-time income event 2 years ago. Maybe they sold a rental property. Maybe they did a Roth conversion, and now 2 years later, they are getting hit with IRMA surcharges based on that one-time income spike. The good news is you can appeal IRMA if your income has since dropped. You fill out Form SSA 44. You document the life-changing event, and you submit it to your local Social Security office. Most people don't know that. Most people just accept the higher premium and keep paying it. Don't do that. Now, I want to talk about something that is deeply important and that connects to why March specifically matters. Social Security pays benefits in arrears, and the payment schedule for March 2026 follows the birthday-based system. If your birthday falls between the 1st and the 10th of any month, you receive your payment on the 2nd Wednesday. If your birthday falls between the 11th and the 20th, you receive it on the 3rd Wednesday. And if your birthday falls between the 21st and the 31st, your payment arrives on the 4th Wednesday. For March 2026, that means payments are being distributed across 3 different Wednesdays. And the updated benefit amounts reflecting the 2026 COLA should already be incorporated into these payments. If you are receiving an amount that does not look right, if the number in your account doesn't match what you expected based on your benefit verification letter, do not assume it will fix itself. Call the Social Security Administration. Go to your local office. Log into your My Social Security account at ssa.gov and check your payment history. You are your own best advocate. Here is something else I want to address because I hear this question constantly from people in their 60s and early 70s. Was it the right decision to claim Social Security when I did? And I want to be both honest and compassionate here because for a lot of people, this has already been decided. But understanding the math of when you claim helps you make smarter decisions about everything else. If you claimed at 62, your benefit was permanently reduced, roughly 25 to 30% lower than your full retirement age benefit. If you waited until 70, your benefit is 24 to 32% higher because of delayed retirement credits. Now here's the real-world impact. On a benefit of $2,000 a month at full retirement age, claiming at 62 might give you $1,400. Waiting until 70 might give you $2,740. The break-even point is typically around 80 to 82 years old. If you are healthy and your family has longevity, waiting is almost always the mathematically superior choice. But I also know that not everyone has that luxury. Not everyone can make it to 70 without touching Social Security, and that is okay. What matters now is that you understand the framework so you can plan everything else around it intelligently. Let me talk about taxes for a minute, because this surprises so many retirees who assumed Social Security was tax-free. Up to 85% of your Social Security benefits can be subject to federal income tax depending on your combined income. Combined income is calculated as your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. If that total exceeds $25,000 for a single filer or $32,000 for a married couple, a portion of your benefits becomes taxable. This is not a new rule. It has been around since 1983, but it keeps catching people off guard because they did not plan for it when they were building their retirement income strategy. If you have significant traditional IRA or 401k balances forcing large required minimum distributions, those RMDs can push your combined income up and trigger taxes on a higher percentage of your Social Security. This is one of the reasons why doing strategic Roth conversions in your early retirement years before RMDs kick in at age 73 can be such a powerful planning tool. And while we are talking about the bigger picture, I want to address something that I know is sitting in the back of your mind. What about the long-term solvency of Social Security? Is it going to be there for me 10, 15, 20 years from now? Here's the honest answer. The Social Security trust funds have been running down their reserves. The most recent trustees report projects that if Congress does absolutely nothing, the combined trust fund reserves could be depleted around 2033 or 2034. Now here is the critical word that gets lost in all the panic. Depleted does not mean zero. Even if the trust fund reserves hit zero, incoming payroll taxes would still be sufficient to pay approximately 77 to 80% of scheduled benefits. So, a cut, yes, potentially, if Congress refuses to act. Elimination, no. And the political reality is that Social Security touches the lives of over 70 million Americans. No politician of either party is going to run on gutting it entirely. There will be reforms, maybe benefit adjustments for higher earners, maybe a change to the retirement age for younger workers. But for people who are already retired or close to it, the likelihood of dramatic cuts is much lower than the headlines suggest. What I ultimately want you to take away from everything I am sharing with you today is this. Your retirement is a system, not just a check. Social Security is one piece of it. Medicare is another piece. Your savings, your investments, your pension if you have one, all of it connects. The people who struggle in retirement are almost never the ones who had the most money. They are the ones who never had a plan. They took Social Security when it was convenient rather than when it was optimal. They never thought about the tax implications of their withdrawals. They never reviewed their Medicare coverage. They just let it happen to them. And I don't want that for you. You worked too hard. You sacrificed too much. And you deserve a retirement that actually feels like the reward it was supposed to be. If this video helped you understand what's really happening to your Social Security in March 2026, please subscribe to Senior Security Updates and turn on notifications so you don't miss future updates. Share this with anyone you know who relies on Social Security. Most seniors have no idea their COLA is being eaten by Medicare premiums. You can be the person who makes sure someone understands what's really happening to their money. I'm Zane, and I'll see you in the next video. Take care of yourselves.